Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 327 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including Berkshire's latest move, equal weight versus market weight performance, market sentiment, an update on Q3 earnings expectations, and we're checking in on the housing market. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you, so let's jump in. Today's episode is featuring myself, Nick Whitaker, Director of Research at Jessup Wealth Management, along with Senior Wealth Advisor Aaron Kramer. Aaron, thanks for joining.
Happy to be here. It's been a while. I'm excited to be on it. We've got some good topics too.
Yes, and you and I have not done a podcast in
It's
a
probably
long
been close
time.
to a year.
Yeah, probably a year. So as always, we will jump into pricing. This pricing is from Y Charts, and it is as of yesterday, which was 11/19. The S&P 500 is down 2.9% month to date and up 12.9% year to date. The Dow Jones Industrial Average is down 3% month to date and up 8.4% year to date. The NASDAQ Composite is down 4.9% month to date and up 16.8% year to date. The iShares Russell 2000 ETF, think small caps, is down 5.2% month to date and up 5.6% year to date. The Vanguard FTSE All-World ex-US Index is down 1.9% month to date and up 24.1% year to date. Checking in on the Treasury market, the 3-month Treasury rate is sitting at 3.95. The 2-year Treasury rate is sitting at 3.58. And the 10-year Treasury rate is sitting at 4.13.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Moving along to big headlines and current events. Aaron, what do you have for us?
Yeah, first thing is just kind of an update on an IRS notice that was put out. It's a highlight of some changes for 2026, specifically around 401k plans, IRAs, all that good stuff. So I'll just kind of read through the changes here. So the annual contribution limit for employees who participate in 401ks, 403bs, governmental 457 plans, and other plans like TSPs is increasing. The annual amount you can contribute is increasing from $23,500 in 2025 to $24,500 going forward. Okay,
Excellent.
So good change for the savers that are maxing it out. You can do an extra $1,000.
Yep, love that.
The limit on annual contributions to IRAs, whether Roth or traditional, is increasing from $7,000 to $7,500. And this is a big one for me. The IRA catch-up contribution limit for individuals age 50 and over that was amended under the Secure Act of 2022 to include annual cost of living adjustment increases is going from $1,000 to $1,100. So basically with that Secure Act going forward, that should be kind of indexed for inflation. So that $1,000 to $1,100 should continue to get bigger over time, like the annual contribution limits do as well. So good stuff for savers. Allows you to save a little bit more, which is important as things get more expensive. You gotta save more to meet your long-term objectives and goals. I'll kick it to you for the other two good headlines we got here.
Yeah, the major one was Nvidia earnings, which they reported Wednesday after the close, so Wednesday 11/19 after the close. Earnings were strong. I think the market was expecting earnings to be strong. I think what the market was particularly looking for was commentary from the C-suite.
They want some guidance on what it looks like going forward, right?
And just There's been a lot of murmurings, talk in the market of overvaluations, and has the AI trade run too far? And the CEO really threw some cold water on that. Earnings were good. He's kind of reassured the market, and the stock is right now. It's 9:12 a.m. on Thursday morning, 11:20. That's Eastern time. The stock is up 5% in the pre-market, so the market's reacting favorably. Obviously, Nvidia is a really big name, so can push the market around.
In the United States, right?
Yeah, in the world. And important to note that that's not a recommendation for or against Nvidia. We're just keeping you up to date on the latest and greatest. Also yesterday, the FOMC minutes came out, and the market moved a little bit. I should say the market expectations for rate cuts following those minutes. So prior to the release, 66% of the market expected no rate cut in December. So that's flipped quite a bit since last time I was on the podcast. After the FOMC minutes, the market, only 60% of the market expects no rate cut. So a little bit of movement.
Yep.
I think not seeing it swing so much is nice. I think the market's a little antsy, kind of looking for a reason.
A reason for the Fed to cut.
Yeah.
Just for listeners, the FOMC is the Federal Open Market Committee, which is basically the Federal Reserve, and they set interest rates, right? So just wanted to clarify that. And these percentages come from basically kind of the futures market. So it's Wall Street traders betting on what the Fed's going to do, essentially. So that's how we're getting these expectations or guesses, basically, right now.
Exactly correct.
Yeah, two good headlines. Nvidia's been really, really strong. Their earnings looked really good, so it doesn't surprise me that it's up pre-market. It's had a little bit of choppiness the last few weeks. So I think again, with all these bubble talks and kind of uncertainty and low sentiment in the market, it doesn't surprise me that Nvidia's been a little bit weak. The market's looking for some justification for those premium valuations, and it kind of got that.
And they provided that justification.
And good guidance as well. Perfect. You all right if I jump into tweets, articles, and research from this week?
Yeah, absolutely. I looked ahead and I saw this. I actually saw something else about Buffett, and this is another thing that's been in the news.
This is surprising to me.
About Buffett hoarding cash and all of that. So yeah, take us away.
Yep. So first topic I have here is an X post by Amit is Investing on November 15th of 2025. And this is titled Berkshire buys 17.8 million shares of Google. That's not $17.8 million. That's shares. So, the tweet goes on to say, Berkshire bought Google after 20 years, likely at a $2 to $2.8 trillion market cap. And people want to say we are in the next .com bubble. The holding company has more T-bills than the Federal Reserve, $300 billion in cash, and never touches technology. Just bought 17.8 million shares of one of the largest CapEx spenders on the planet, projected to spend $93 billion next year on data centers, while at the same time does $100 billion in net income, and we are somehow in a .com bubble, okay, with a lot of A's. So I like that tweet. It's really interesting because, Buffett and Berkshire's thesis on investing has been basically buy value plays. So companies that they feel are undervalued, throw a lot of cash into them, help them grow and become more profitable over time. So it's kind of an interesting shift in Buffett's strategy or Berkshire's strategy overall. And, Google's pretty much at all-time highs, right? So
Google's been one of the strongest performers over the past couple of months.
The past decade, right? So really interesting that he would do that. I think it speaks volumes on the strength of AI and technology going forward. So,
and I think hopefully this gives listeners who are hyper focused on Buffett's cash, maybe that calms them down a little bit.
He's putting it to work, right?
He's putting it to work in one of the Mag 7 high flyers, so to speak. And really, what I think this is a very bullish thing in general for all the naysayers out there. Google has had kind of an interesting story since the beginning of the AI trade, and maybe let's take that back to early 2023. At first, there was a lot of concerns that the AI trade was was going to be a bad thing for Google, and so they kind of struggled, and there was concerns of. I read an article maybe a week or two ago about is the CEO of Google the wartime CEO? Who's more of a peacetime CEO, and
Right.
now they're coming up against a lot of competition with the AI trade, and it was kind of an analysis over the past couple of years of how did he do it, because the stock's performing so well, the company's performing so well, and then you see someone like Buffett, who's a long-term shareholder, come in 2 years later after the stock. And the CEO has done a great job, to his credit, to the company's credit. But if you remember, I want listeners to try to put this together. I want you to remember when you were Googling things 2 years ago. I know it's really tough. We Google things all the time.
It wasn't that good, was it?
It was
good.
fine. It was fine. It was the normal Google, but you remember the beginning of the AI kind of overview. Remember that at the beginning?
Threw that at the top.
It threw it at the top, and it was pretty bad.
Yes.
And there was a lot of negativity on it, and that's why the market, it's 2023, right, was saying, "Ooh, we've got ChatGPT stealing search. We've got Google, paying." Other companies to make sure that Google is the number one search engine.
Right, exactly.
So there's that negative. And, this AI that they're throwing on top, it doesn't look that great. Fast forward to today, I want you to think about how good the AI over the top is relative to what it was 2 years ago. That's just me colloquially bringing that up as a user of the search engine. And I think that is a good way for investors, just people at home listening to this, to think about, okay, well, what changed and what has happened in that 2 years? They made their product better, and they proved that they are going to be able to compete in the AI trade with some of these other guys, and that's why the stock has performed well. And if Buffett's buying it, he clearly likes it. So
absolutely, and their investments in data centers is just huge. So maybe that's another reason Buffett wants exposure to that versus an Amazon or a Meta or Microsoft. So those are kind of the big names in data centers. So very interesting, kind of a change of trend for Mr. Buffett there, putting some of that cash to work, which is good, because Wall Street's been drastically kind of under allocated to equities this year. So it's interesting to see one of the big heavy hitters putting some cash to work now.
Indeed.
Awesome. Are you all right if I go to my next topic?
Yes.
Perfect.
Take us to Seth Golden.
Yep. Always has good stuff. This is from, like Nick said, Seth Golden on November 13th. It is an X post, and the post is kind of titled Switch Strategy. So he's basically giving some data on performance of equal weight S&P 500 returns versus normal weight or market cap weighted. So I'll just kind of read what he says here. 6-month stretch, November to April, has proven a profitable time for stocks. Equal weighted S&P returned an impressive 19.5% annualized from November to April versus a modest 4.1% from May to October, and historically outperforms cap weighted S&P 500 or SPX. 25 of 35 years, RSP, which is the equal weight S&P 500 index, beat SPX November through April. So I'm going to back up and explain what that is to listeners first. So the S&P 500 index is a market cap weighted indices. So that means the bigger names in that top 500 have more of an impact based off of their share values and their market cap values. RSP, which is the equal weight, basically spreads out every sector as kind of equal. So if, say, every stock was worth $100, you'd have the same value in every single stock or sector, essentially.
It basically just takes the 500 tickers listed in that index and just buys them exactly the same weight.
Yep. So basically, I mean, what this kind of means in my world is smaller names, maybe some more value plays. I say smaller in air quotes because it's obviously large cap, right? They're still really big, but smaller relative to an Nvidia, relative to an Apple, right?
They're still hundreds of billions of dollars.
They are. Otherwise, they wouldn't be in the S&P 500. So just some of the largest weightings in the S&P 500 is IT, information technology, financials, consumer discretionary, and communication services. Think telecom, all that stuff. The smaller weights would be healthcare, industrials, consumer staples, energy, utilities, real estate, and materials. So what this means in my world is that those smaller weightings and those kind of out of favor trades, in theory, should do well over that November to April time period, while maybe some of the heavy hitters, larger weightings, aren't performing as well. So really interesting. Kind of would be a trend towards more value oriented plays, and maybe some more boring names in the S&P 500, right? Not the Mag 7.
Yeah, names that are generating less headlines.
Exactly.
They may not be household names as much, even though they are $200-300 billion companies. They're not Google or Meta, et cetera. And speaking of Google and all of these companies, these are not recommendations for or against any.
We're
of
just
these
throwing
names.
those out there because they're the biggest examples in the largest weightings and biggest sectors in the S&P 500. So I think IT makes up like 33% of the S&P right now. So that sounds right. It's a third of it. So it's pretty interesting. So we'll see if this strategy holds true. 25 out of 35 years is pretty good.
Yeah, that's pretty solid.
Pretty solid.
Could see some cap rotation. I think the market's been expecting some cap rotation for some time, but just hasn't happened.
Like I mentioned earlier, with Wall Street, generally being under allocated to equities, they're probably going to look for a cheaper play or more value play.
That's a good point.
So some rotation outside of technology and financials that have done really well year to date, could be in, a healthcare or a consumer staples, things like that. Again, not a recommendation for those industries or areas, just kind of my general thoughts on it.
Very nice.
Very good. I got one more for you. Another X post by our friend Ryan Dietrich, always putting out great stuff. This is on November 16th. And this topic is kind of market sentiment. So his X post here says, things you don't usually see when the S&P 500 is 2.3% away from all-time highs. The Economist with another over-the-top bearish cover about how a crash is imminent. AAII bears at 49%, highest with stocks near all-time highs since 2013. CNN, fear and greed, and extreme fear. So it is really interesting, like he says. The market's basically at all-time highs for the most part, minus a few percent. But all of the news headlines, all of the sentiment would indicate the exact opposite, right? So there's some sort of disconnect between what investors are feeling and what the market's doing. So I don't know why that is. I think it's just fears about a potential tech bubble and pullback.
Yeah.
But then again, we have numbers and earnings reports like Nvidia to back up those valuations going forward, right? So just wanted to throw that out there for listeners that the AAII is the American Association of Individual Investors. So it's basically a survey. I take a survey with a grain of salt, right?
It's soft
data.
Market sentiment data. So it's basically going out and asking investors, how do you feel about the markets?
Yeah,
essentially.
And it could be for various reasons. I don't know. It's really strange because typically when people would be kind of this bearish on the market, we're normally touching on the trough in market pullbacks, right? When people are normally this fearful and this upset about the market, it's a really good time to buy, right? But it's kind of flipped. I don't know.
And I think we've seen this at different points over the past couple of years where the market performance and market sentiment have just been
not correlated with market performance.
Really on a divergent path. If you think back to the beginning of the election and right around that period, the market sentiment was really low and the market was doing fine. And immediately after that as well. So we'll see. We'll see what happens.
Yeah, I don't know. It could just be general, people's general opinions on the economy and their, not so much what the market's doing, but just generally out in the world right now, which is kind of strange. But we'll see. We'll see if the market continues to hold up into year end and going forward. But my general opinion is that if companies like Nvidia back up their valuations with earnings, I feel comfortable saying I think the market can go higher for a period of time.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Yes, speaking of, that's my first topic is, kind of coming in and trying to provide some more insight on earnings growth, EPS growth, and margins. You think about market sentiment, you think about the news, the headlines, and the worries about the AI trade and comparing it to the dot-com bubble, et cetera, et cetera. So all of my research pieces today are from Charlie Bilello's The Weekend Charts. He released these on the 13th. And the reason I did this is because, honestly, there were
He always puts out good stuff.
There were a ton of really good pieces in here, and I was fighting between which ones I wanted to put in here.
So you just put them all in?
So I put in 3 of the 6 or 7 that I really liked, just because I think they're timely and I think they will help listeners. So the first one is on earnings growth and EPS margins, and this is the highest beat rate since 2021. Over 80% of S&P 500 companies have beaten earnings thus far. That's the highest beat rate since the second quarter of 21. In total, Q3 earnings are coming in over 10% above analyst estimates, which is the highest upside surprise since 2021 as well. I'm going to stop there.
And we're surprised that the market's at all-time highs.
Exactly. I'm going to stop there and remind listeners, a couple months ago, heading into earnings, I had a piece that was showing that that analysts were increasing their estimates heading into earnings, which was a sign that things are very bearish. And that there was a lot of research at the time saying, hey, you could expect to see some strength in the markets and some beats, because historically you see analysts lowering their expectations into the quarter. So
their price targets, basically.
Exactly.
On the stock.
Yeah, their expectations for earnings. Yep. Charlie says this: with 81% of companies reported, the S&P 500 operating earnings are up 24% year over year, the 11th straight positive quarter, and the highest growth rate since Q4 of 21. And he said the big story this quarter has been margin expansion, with the S&P 500 companies posting a 13.4% operating margin, the second highest level on record.
That's interesting.
13.4% operating margin, operating profit margin, which is the second highest level on record. So that just speaks to some of the health of these companies and the health of their earnings. So again, when we talk about it all the time on the podcast, earnings are what drive stocks.
Absolutely.
Earnings is the bottom line, the fundamentals, and the earnings were very strong this quarter, as we expected.
No matter what the average investor feels about the market, these earnings are what really moves it, right?
Mm-hmm. Exactly. My second piece is checking in on the housing market. The housing market is still tough. I don't think that's going to surprise anybody. This piece is titled "Delaying the American Dream."
Yeah, that's a sad title, isn't it?
It is a bit. I gave you good news with the earnings. I'm going to give you some bad news with the housing market. And this is not new news. This has been we've talked about this piece at least every couple of months. We check in on this. So Charlie says the median age of the first-time home buyer in the U.S. has moved up to 40 from 31 a decade ago. The reason this is by far the most unaffordable housing market in history. So there's a couple charts we can throw up here, but one just shows the housing payment as a percentage of median income.
Interesting.
So it's still up there, the 47 kind of range, which is
so basically the middle earners, middle income, or middle payment for kind of not an average, but basically would be 40% of the average income in the United States. 47%. Wow.
Yeah, and I think the median home
and
price
then that
is,
means you can't even get a loan for that, right? Because no lender is going to give you that right now because underwriting requirements are stringent. So
yeah, which pushes you
which is a good
down
thing.
to a lower priced home, which there are less of those available. There's the supply kind of
right.
a portion to that, and then. And don't quote me on this, but I'm going to give you an estimate. The median home price in the U.S. is somewhere in the 400,000 range.
Yeah, low fours, I would guess.
Yeah, 420. I want to say I haven't
Sounds
checked
right.
in on it in a couple of months, but it's somewhere in that range. So
And it's really interesting because just my perception is housing supplies picked up a lot.
it has,
But and we haven't seen a massive move in prices yet.
we have.
So I think for listeners that might be searching for a home or thinking about moving, my guess is, maybe I'm being optimistic, but I think things will get more affordable in the next year or so. Number one reason, the Fed has started to cut rates, right? So rates will make a big impact. So where rates were 7% a year or two ago, they're starting to come down. I think I looked yesterday, the average mortgage rate's somewhere 6.1, 6.2, something like that.
That sounds right. Yeah.
So,
Which I think is the historical average.
we're right at long-term averages. I think the difference, or the thing I'll say, is that inflation's still relatively low. So there's still that disconnect between the Fed funds rate and inflation. So in my world, rates should still probably come down another % or so, which in theory would move, mortgage rates down another %, right?
Yeah.
So I think terminal rate for the Fed's probably somewhere around 3. I think, unfortunately, those ultra low COVID rates of
Those aren't.
those aren't coming back anytime soon, in my opinion, unless something really goes wrong, which we don't want. So I think this is a little bit more of the new normal from the rate kind of a level. But it's really prices versus income that's impacting people. And I don't know if it's because housing prices have gone up that much or because wage growth hasn't gone up enough, right? Probably a combination
of the two. Yeah. So we'll see. We'll continue to check in on the housing market for listeners. But just,
it's a good little data point. I like it.
More bad news there. Or I guess just continued bad news. My last piece is a fun one on robot taxis.
Question before you start: would you ride in one of these?
See, this is why I bring this up, because I would. I think about the movie I, Robot with Will Smith, and
that's a creepy movie. Now that we move more towards AI,
yeah. If we should all go back and watch that movie. Because we might be living in, and there are portions of it that are relevant. Robo taxis being one of them. So this is a research on Waymo's paid driverless trips in California. So self-driving taxi company Waymo, which is owned by Google, is now doing 1 million rides per month in California.
That's a lot.
It's 3 times the increase over the past year and 26 times increase over the past 2 years. There's a chart we'll throw up here. There was kind of a dip in interest in
the summer,
in summer, which is
strange.
It's really strange. I don't fully understand.
There was probably this is me speculating. Probably some weird news or Waymo wrecked into something, and people were like, "Oh, I'm not doing that for a month," and then they revert back to their old ways.
Yeah, but this is a lot of rides, and it's interesting.
It is super interesting.
Just to let listeners know, if you're in big cities, this is coming.
For
you
sure.
could start seeing this more and more.
I mean, 1 million rides. Obviously, there's millions and millions of people in California, so it's going to be the biggest use market. But super interesting. So you think you would ride one? I don't know if I'm there yet. And
I think I would.
It's probably safer than a normal Uber driver because we've all probably had a crazy Uber driver experience.
Yeah.
But I don't know. I'm not there yet.
I think for me, it would probably be weather dependent.
Okay.
Knowing No, reading the research and understanding how Waymos work relative to others out there, Tesla's self-driving, and they're way more expensive to produce, like
I'm
4 times the
sure.
cost, but it's because they use radar, they use 3 or 4 times the amount of cameras, they use sensors, they use all of it. My hesitation in weather is that, weather is unpredictable and I just, I don't know.
Good news for
That's the one
California.
thing,
Doesn't rain a lot.
Yeah, exactly. It's like if I'm in Buffalo and there's 6 feet of snow on the
You're
ground,
not getting in a Waymo.
I don't know if I want to.
That's fair.
There's just an example of kind of where I'm at in the whole situation.
A random thought, but I don't see this happening in a state like a New York or a New Jersey where taxis are still very common. It's just an interesting thought with unions. I don't see, California is a pretty good use case for this technology.
Plus the companies being out there.
Exactly.
That's a big, and the weather again is
more favorable.
And
well, it's a good use case too, because traffic out in California is a nightmare. And there's not, a lot of, or pretty much any public transportation in California, right outside of San Francisco. So it's a really good use case, and it's interesting to see how much it's grown over the last 2 years. It's incredible.
Yeah, quite the change. 26 times increase over the past 2 years.
It's really big. I mean, it just goes to show like how much technology is getting more and more ingrained in our lives, and it's interesting because it does put a driver out of a job, but how many engineers behind the scenes does it take to operate this right now, right?
Yeah, and to build them,
and to
analyze the
test
data,
them.
and
so
fix
very
the software, and how do you test when the sensors are going bad? How do you run that data?
How do you service them, right? Because I'm sure servicing is
Yeah.
much more complicated than an average Toyota Camry, right?
Oh, yeah.
So really interesting. I like that. It's a good piece of data.
That's just a fun one for listeners, so hopefully they enjoyed it. So
if any listeners are in a Waymo, let me know how that experience
reach
went.
out. Let us know. Let us know what you think. Would you do it in inclement weather?
All right, good topics. I don't have anything else. Do you have anything that's top of mind before we sign off here?
I do not. So thanks for joining, and to everybody out there, thank you for listening to episode 327 of the Independent Advisors Podcast. We will be back with you next week for episode 328.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.